Hi everyone, today we're talking about accounting for transactions in a merchandising operation. We're under the periodic system and we are dealing with sales transactions today. I'm your instructor Brandy. So just going back to our business cycle for a merchandiser for just a moment. A merchandiser buys inventory, so they spend cash, and then they sell the inventory hopefully for a profit, making money so that they can buy more inventory. In this video, we're talking about selling our inventory, and we are under a periodic system. Remember that under the periodic system, we do not have to update our inventory at every transaction. And we're going to be going through the same examples that we went through under the perpetual method video. So under this example, Parker's Shoe Store sells shoes to customers for $1,000 cash on May 15th. The shoes cost Parker $300. Because we're under a periodic system, we're not worried about updating our inventory every single transaction. We only worry about it at the end of the month or the end of the year whenever we're making our financial statements. So we can just cross out this last sentence. We're not concerned with the cost of the shoes to Parker's Shoe Store. Because we don't need to worry about recording the cost of goods sold and taking the inventory out of our warehouse just yet, we only have one journal entry for our sale. Our journal entry is going to look like this. Our debit is to cash because the customers are paying right away, and the credit is to our sales revenue account for $1,000. So that's a basic sales transaction. Let's talk about when the customers pay on account, and we offer sales discounts for quick payment. So in this example, Parker's Shoe Store sells $1,500 worth of shoes to a customer with terms 1, 15, and 30 on May 17th. The shoes cost Parker's Shoe Store $450. Under the periodic method, we're not concerned with keeping our inventory up to date, so the cost of the shoes at this point does not affect our transaction into our accounting records. So our journal entry is going to look like this. Debit to accounts receivable and credit to sales revenue for $1,500. In our description, I'm entering in the terms just to reference back to when the customer actually pays us. Then on May 23rd, the customer sends us a check for the full amount that they owe us. At this point in time, we ask ourselves, is this customer within the discount period? The answer is yes, they're paying within that 15 days. Because of this, they get to take advantage of the discount for paying quickly. The journal entry for this transaction is going to look exactly the same as it did under the perpetual method. First, we're going to cancel out our accounts receivable for the full amount owing, so credit accounts receivable for $1,500. The next step is to calculate your discount, 1% of $1,500, and that discount is going to go to the account sales discounts as a debit. The difference between those two numbers to make your debits equal your credits is the cash that we're receiving on the transaction. Now let's go on to sales returns and sales allowances. In this example, a customer returned shoes that they had purchased for $200, and the return took place on May 25th. Our debit is going to be to our sales returns and allowances account, and our credit is going to be to cash if we're paying the customer right away, or to accounts receivable if they haven't paid off their bill yet. And the difference between the perpetual and the periodic system here is that there's only one journal entry when we make a sales return because we don't have to update our inventory account on every transaction. In our next example, we're going to focus on a sales allowance rather than a sales return. We're granting a sales allowance for $25, but the accounts that we use are going to be identical. The transaction is going to look exactly the same. Now that you've watched this video, you should be able to account for sales transactions under the periodic method. Thanks for watching, everyone.